I've watched people destroy their retirement savings for 70 years and the methods never change. They think safety comes from avoiding risk. It doesn't. Safety comes from understanding what you own and why you own it. Most retirees confuse comfort with security. They want something that feels safe, not something that is safe. There's a difference. A certificate of deposit feels safe because the number doesn't move. But if it's paying 3% while inflation runs at 5%, you're getting poorer in slow motion. That's not safety. That's suicide with a smile. Let me be clear about something. There's no such thing as a perfectly safe investment. Anyone who tells you otherwise is either ignorant or selling something. What exists are intelligent trade-offs. You can trade growth for stability. You can trade liquidity for yield. You can trade complexity for simplicity, but you cannot have maximum safety, maximum returns, and maximum liquidity all at once. The universe doesn't allow it. When people ask me about safe investments for retirement, they're usually asking the wrong question. They want me to name products, but products don't make you safe. Thinking makes you safe. I could give you the 3 best investments for retirees, and you could still lose everything if you panic at the wrong moment or chase yield at the wrong time. So before I tell you what to own, understand this. The biggest risk in retirement isn't the market, it's you. Your emotions, your impatience, your need to feel clever. Those kill more portfolios than any recession ever could. Now, if you can control yourself, if you can sit still when everyone else is running, if you can think clearly when fear is screaming, then these 3 investments will serve you well, not because they're magic, but because they're designed for survival. They won't make you rich overnight, but they'll keep you from dying poor. And in retirement, that's the only game worth playing. The first investment every rational retiree should own is something so boring that most people can't stand it. They want excitement, they want growth, they want to feel like they're doing something, whether they keep sending dividend checks, and they will, because people don't stop drinking Coke during recessions. They don't stop brushing their teeth or doing laundry. Human habits are remarkably stable even when markets aren't. That stability is worth more than any growth stock's promise of doubling your money. When you own dividend aristocrats, you're betting on something reliable. Human behavior. People will keep consuming the same basic products they've consumed for 50 years. That won't change because some politician got elected or some central bank changed interest rates. The beautiful part about dividend stocks is they solve 2 problems at once. First, they give you income without forcing you to sell shares. That matters enormously in retirement because selling shares during a crash locks in losses. If you're living off dividends, you never have to sell. You just collect the checks and wait for sanity to return. Second, they anchor you psychologically. When markets fall and everyone's panicking, it's much easier to stay calm if cash is still flowing into your account. You're not watching a number on a screen. You're receiving money. That makes all the difference between perfect. Their prices will fall during bear markets, but the income keeps coming. And income is what pays your bills, not stock prices. If I were building a retirement portfolio from scratch, I'd start here, 40 to 50% in a diversified basket of dividend aristocrats, not 1 or 2, at least 10 or 15 across different industries. You want consumer staples, healthcare, industrials, companies that make things people actually need, not things people want when they're feeling optimistic. This isn't about getting rich. It's about staying rich. And the best way to stay rich is to own pieces of businesses that generate cash regardless of what the economy is doing. That's the first pillar, income that doesn't quit when markets do. Let me tell you something about dividend investing that nobody mentions. It's not just about the money, it's about the psychology. When you're 70 years old and markets are crashing and every talking head on television is predicting the end of the world, you need something to hold on to. Not hope, not predictions, something concrete. A check that arrives every quarter regardless of what the Dow Jones did yesterday. That's mental armor. I've watched retirees with Perfect portfolios panic and sell everything because they couldn't handle the psychological pressure of watching their net worth fluctuate. They had no anchor, nothing to remind them that their businesses were still functioning, still selling products, still making profits. Dividends provide that anchor. Every time you receive one, it's proof that your investment thesis is still working. The company is still generating cash. Your retirement isn't dependent on some greater fool buying your shares at a higher price. You're getting paid for ownership. That's real. That's sustainable. And that's what lets you sleep at night when everyone else is awake worrying. Now, let me address something that confuses people. They see a stock yielding 2 or 3% and think that's not enough to live on. They're right, but they're missing the point. The yield is just the starting point. What matters is the growth of that yield over time. If you buy a stock yielding 3% today and that company raises its dividend 7% per year, in 10 years you're earning a 6% yield on your original investment. In 20 years, 12%. That's the power of dividend growth. Your income rises while your cost basis stays fixed. Compare to bonds. You buy a bond yielding 4%, you'll earn 4% forever. No growth, no inflation protection, just a slowly eroding real return. Dividend growth stocks give you both income and inflation protection because good companies raise prices. And when they raise prices, they can raise dividends. You're not fighting inflation, you're benefiting from it. That's why I've always preferred stocks to bonds for retirees. Yes, stocks are more volatile, but volatility and risk are not the same thing. Volatility is price movement. Risk is permanent loss of capital. If you're not selling, volatility doesn't hurt you. It's just noise. But inflation hurts you every single day, whether you notice it or not. The other beauty of dividend aristocrats is they're self-selecting for quality. To raise your dividend every year for 3 decades, you can't be reckless. You can't overlever your balance sheet. You can't make stupid acquisitions. You have to run a tight ship because if you cut the dividend, you lose your status. Investors flee. Your stock gets crushed. So these companies are institutionally conservative. They built cultures around capital discipline. That's exactly what you want in RET. Not companies swinging for the fences, but companies playing not to lose. There's another benefit that's harder to quantify, but equally important. Dividend aristocrats tend to have boring, stable businesses. They're not disrupting anything. They're not changing the world. They're just selling soap and toothpaste and soda. That sounds uninspiring until you realize that boring businesses survive. Exciting businesses often don't. I've seen countless revolutionary companies disappear. I've never seen Colgate-Palmolive disappear because teeth don't become optional. That predictability is worth paying for. When you're 75 and living on your investments, you don't want to worry whether your holdings will exist in 10 years. You want businesses with moats so wide that even terrible management couldn't sink them quickly. Consumer staples provide that. Healthcare provides that. Utilities provide that. These aren't growth engines. They're survival machines. And survival is what retirees need most. Now, I know what some people are thinking. What about technology? What about innovation? Shouldn't retirees own the future? No. Retirees should own the present. Let young people bet on future. They have time to recover from being wrong. You don't. That doesn't mean avoiding all technology. Microsoft and Apple are dividend aristocrats now. They've matured from growth stocks into cash-generating machines. That's fine. But buying speculative tech hoping to catch the next Amazon, that's not investing. That's gambling. And gambling in retirement is how you end up working at 75. Stick to businesses you understand, businesses that were profitable 20 years ago and will be profitable 20 years from now. Businesses where the competitive landscape doesn't change every 18 months. That's not exciting, but excitement is expensive. Boredom is profitable. I'll give you a specific example of how this works in practice. Let's say you retired in 2000 with $1 million. You put half in dividend aristocrats yielding 3% on average. The other half you put in tech stocks because everyone said the internet was the future. By 2002, your tech stocks were down 70%. Your dividend stocks were down maybe 20%. But your dividend stocks were still paying you $15,000 per year. Your tech stocks were paying nothing. Many went bankrupt. Now fast forward to 2024. Your dividend stocks have not only recovered, they've compounded. Your income has grown to $40,000 or $50,000 per year from the same original investment. Your tech stocks, some recovered, most didn't. Even if you picked the winners, you spent 20 years stressed about whether you'd made the right bets. Meanwhile, the dividend investor just collected checks and slept well. That's the difference between speculation and investment. Speculation requires being right. Investment just requires not being catastrophically wrong. And the best way to avoid catastrophe is to own businesses that have already proven they can survive anything. So when I say dividend aristocrats are the first pillar of retirement safety, I'm not just talking about income. I'm talking about psychological stability, inflation protection, capital preservation, and the freedom to ignore market noise, all wrapped into one boring package. Most people won't do this. They'll chase higher yields from riskier sources. They'll buy junk bonds or preferred stocks or master limited partnerships. They'll learn the hard way that yield without safety is just a loan you're making to someone who probably can't pay you back. Don't make that mistake. Accept lower yield. Trade, they switch funds, they chase performance, and every time they do, they destroy their returns. The data is brutal. The average investor underperforms the market by several percentage points per year, not because they pick bad stocks, but because they can't sit still. They buy high when they're excited and sell low when they're scared. Index funds solve this by making activity pointless. There's nothing to do. The fund rebalances automatically. You just sit there and let capitalism work. Now, people worry about market crashes. They say, what if I invest and the market falls 30% next year? My answer is simple. Then it falls 30%. So what? If you're retired and living off dividend stocks for income, your index funds are for growth 20 or 30 years from now. You're not spending that money this year or next year. You're spending it when you're 85. By then, every crash will be ancient history. The key is structuring your portfolio so you're never forced to sell during downturns. That's what the dividend stocks and cash reserves are for. The index funds just sit there compounding quietly while everyone else panics. I've watched this pattern repeat for 70 years. Markets crash, people sell in terror. Markets recover. People who sold regret it, then markets rally. People buy in excitement, then markets crash again. It's the same cycle endlessly. The only investors who win are the ones who ignore the cycle completely. Index funds make that easier because there's no company-specific news to worry about. You don't care if one tech company misses earnings or one bank gets downgraded. You own all of them. If one fails, another succeeds. That's diversification. That actually means something. If I were allocating a retiree's portfolio, I'd put 30 to 40% in a total market index fund. Low cost is critical. You want expense ratios under 0.1%. Every extra percent you pay in fees is a percent you don't get to compound. Over 30 years, fees can cost you a third of your wealth. That's not a rounding error. That's theft. The beauty of index funds is they scale with the economy. When the economy grows, your fund grows. When productivity improves, your fund captures it. You're not betting on one CEO's brilliance or one industry's future. You're betting on aggregate human effort. And humans are pretty good at creating value over time, even if they panic regularly. So the second PI, LR, is simple. Own everything through index funds, not because it's exciting, but because it's effective. Not because it's clever, but because it's durable. You don't need to be smart to own an index fund. You just need to stay invested. And staying invested is where most people fail. Let me tell you why index funds matter specifically for retirees. It's not just about returns, it's about removing decisions. Every decision you make is a chance to be wrong. Every trade is a chance to panic. Every rebalance is a chance to screw up. Index funds eliminate most of those chances. You buy once, you hold forever. Done. That simplicity is powerful because retirement is when your decision-making ability starts to decline. I don't care how smart you were at 50. At 80, you're slower. That's not an insult. That's biology. Your reaction time slows. Your ability to process complex information declines. You become more susceptible to scams and bad advice. So, the last thing you want at 80 is a portfolio that requires constant attention and sophisticated decisions. You want something you can ignore, something that works whether you're paying attention or not. Index funds do that. They're the ultimate set it and forget it investment. And that's exactly what you need when your cognitive abilities aren't what they used to be. There's another benefit that's often overlooked. Index funds prevent you from making emotional decisions based on news. When you own individual stocks, every earnings report feels personal. Every analyst downgrade feels like an attack. You start second-guessing yourself. Should I sell? Should I buy more? Is this company still good? With an index fund, none of that matters. You don't own any single company enough to care about its quarterly results. You just own the aggregate. And the aggregate always goes up over time because that's how capitalism works. Bad companies die, good companies thrive. The index automatically adjusts. You don't have to do anything. That autopilot feature is worth its weight in gold for retirees because the worst investment mistakes happen when you're stressed, tired, or scared. And retirement brings all three: health problems, loss of spouse, cognitive decline, market crashes, political chaos. There's always something trying to make you panic. Index funds help you resist that panic by removing the need to act. You can't panic. Sell an index fund and feel smart about it because you'd be selling everything, the entire productive economy. That's obviously stupid. So you don't do it. But you might panic sell individual stocks because you can tell yourself a story about why that particular company is doomed. Index funds prevent that self-deception. I've also noticed that index fund investors sleep better, not because their returns are better, though they often are, because they're not constantly second-guessing themselves. They're not lying awake wondering if they should have sold Microsoft or bought more Apple. They're just invested in the market, and the market will do what it does. That peace of mind is priceless. I'd pay a lot to sleep well. Most people pay a lot and still sleep poorly because they're making investing harder than it needs to be. Now, some people object to index funds on philosophical grounds. They say you're investing in companies you don't believe in, companies that pollute or make weapons or do things you disagree with. That's true. When you own an index, you own everything, the good, the bad, and the ugly. My response is simple. Your job in retirement isn't to fix the world. It's to not run out of money. If you want to fix the world, do it with your time and energy, not your retirement savings. Because the moment you start screening companies for ethics or values, you introduce bias. And bias costs money. Study after study shows that value-based investing underperforms. Not because doing good is bad, but because you're shrinking your opportunity set. You're eliminating companies that might have great returns because they don't meet some arbitrary standard. In retirement, you can't afford that luxury. You need every advantage you can get. And the biggest advantage is broad diversification. Owning everything means you can't miss the winners. If you screen out oil companies and the next decade belongs to energy, you've hurt yourself. If you screen out tech and tech dominates, you've hurt yourself. The market doesn't care about your values, it rewards what works. Your job is to capture those rewards, not judge them. That might sound cold, but I've watched too many well-meaning retirees impoverish themselves trying to invest according to principles instead of math. Their principles didn't pay their medical bills. The market did. So yes, own the whole market. The MO, real and the immoral, the popular and the hated, all of it. Because your retirement security is more important than making a political statement with your portfolio. Save your activism for your volunteer work and your votes. Keep your investments ruthlessly pragmatic. There's one more reason index funds matter for retirees specifically. They're incredibly tax efficient. When you own individual stocks and you need money, you have to sell specific shares. That creates taxable events. You have to track cost basis. You might trigger short-term or long-term capital gains. It's a mess. With index funds, especially in retirement accounts, it's simple. The fund rarely distributes capital gains because it rarely sells holdings. It just holds everything. So your money compounds tax-deferred or tax-free depending on the account. That's huge over 30 years. I've seen people lose 20 or 30% of their potential returns to taxes simply because they were constantly trading. Index funds solve that by encouraging inactivity. And inactivity is both tax efficient and psychologically healthy. Let me give you the bottom line on index funds. They're not exciting. They won't make you feel clever. You can't brag about them at parties, but they'll quietly make you wealthier than 95% of investors who are trying to be clever, because investing isn't about being clever, it's about being right. And the easiest way to be right is to own everything and wait. That's what index funds let you do. So the second pillar of retirement safety is a broad market index fund, 30 to 40% of your portfolio. Low cost, boring, effective. You buy it, you forget about it, you let it compound for the next 20 or 30 years. And when you're 90 and need money, it'll be there. Grown quietly while you were busy living your life. That's the point. Investing should be something that happens in the background while you focus on what matters. Family, health, experiences, not stock charts and earnings calls. Index funds make that possible. They're the investment equivalent of autopilot. Set your destination and relax. The system will get you there. That's the second investment, simple, durable, unstoppable. The third investment retirees need is the one most people resist because it doesn't look like an investment at all. It pays no dividends, it produces no growth, it just sits there doing nothing while inflation quietly erodes its value. I'm talking about cash. Not cash under your mattress, not cash in a checking account earning zero. Cash equivalents, short-term treasury bills, money market funds backed by government debt, the kind of assets you can turn into spending money in 24 hours without losing sleep. People hate holding cash in retirement. They think it's lazy. They calculate opportunity costs like it's a moral failure. They see stocks climbing and feel stupid for not being fully invested. That's exactly backward. Cash isn't dead weight. It's strategic positioning. It's your defense against being forced to do something stupid at the worst possible moment. Let me explain what happens to retirees without cash reserves. Markets crash. They need money to live. They have to sell stocks. Stocks are down 40%. They sell anyway because they have no choice. They've now locked in permanent losses. Then markets recover. They've missed the rebound. They're poorer forever. All because they didn't hold boring cash when it was available. I've seen this tragedy play out hundreds of times. Smart people, good portfolios, one mistake. They structured their finances as if markets would never fall, or as if they'd never need money during downturns. Both assumptions are insane. Markets always fall eventually. You'll always need money. Cash solves this by removing urgency. When you have 2 or 3 years of living expenses in treasury bills, you don't care what the stock market does tomorrow. You're not selling. You're just spending cash you already set aside. That freedom is worth more than any yield. During the 2008 financial crisis, the people who survived weren't the ones with the highest returns in 2007. They were the ones with enough liquidity to avoid selling at the bottom. They could sit still while everyone else was forced into motion. That patience saved them. In some cases, it made them wealthy because they could buy when others couldn't. That's what cash gives you. Optionality. When markets are high, you spend cash. When markets are low, you let stocks recover and spend cash instead. You're always acting from strength, never from desperation. The correct amount of cash depends on your spending. If you spend $50,000 per year, hold $100,000 to $150,000 in cash equivalents. That's 2 to 3 years of expenses. It sounds like a lot. It is. That's the point. You want enough runway that even if stocks fall 50% and stay there for 2 years, you're fine. You're not stressed. You're not making decisions based on fear. People will argue that holding 3 years of expenses in cash means missing out on stock market gains. True, but it also means missing out on forced liquidations during crashes. I'll take that trade every time because the goal in retirement isn't maximum returns, it's maximum survival. Here's another benefit nobody talks about. Cash makes you a better investor. When you know your bills are covered for years, you think more clearly. You stop reacting to headlines. You stop checking your portfolio every day like it's a sports score. You can actually wait for rationality to return. Without cash, you're vulnerable. Every market dip feels like an emergency. Every news cycle feels like a call to action. You start making emotional decisions disguised as strategy. That's how people blow up. They confuse activity with intelligence. Now, some people say holding cash is risky because of inflation. They're right in one sense. Cash loses purchasing power. But losing 2% per year to inflation is nothing compared to losing 40% in 1 month because you sold stocks in a panic. Risk isn't one-dimensional. The risk of holding too little cash is far greater than the risk of holding too much. Short-term treasury bills are as close to risk-free as you'll find. They're backed by a government that can print the currency it owes you. They're liquid, they're boring, and they give you exactly what retirees need most: peace of mind. If I were structuring a retirement portfolio, I'd allocate 20 to 30% to cash equivalents, not forever, just as a buffer. As you spend it down, you refill it by selling stocks during good times. It's a rotating reserve, not a permanent parking lot. The key insight is this: liquidity is an emotional tool as much as a financial one. It keeps you rational when rationality is most valuable. It prevents you from doing something irreversible at the worst possible time. That's worth far more than chasing an extra % of yield. So, the third pillar is simple. Hold cash not because it's exciting, but because it's stabilizing, not because it earns returns, but because it prevents disasters. Retirees don't need hero portfolios. They need portfolios that can't be killed by bad luck or bad timing. Cash is how you build that. Let me tell you what cash really represents. It's not about the money itself. It's about time. Cash buys you time to think, time to wait, time to let markets recover without being forced to participate in their insanity. That time is more valuable than any investment return. Because the biggest mistakes in investing are almost always mistakes of timing. Buying too late, selling too early, acting when you should wait, waiting when you should act. Cash eliminates most timing mistakes by removing the pressure. You're never forced to act. You can always afford to wait 1 more day, 1 more month, 1 more year. That patience is what separates successful retirees from broke ones. I've seen people with millions panic because they didn't have enough cash to feel secure. And I've seen people with modest savings sleep peacefully because they had 3 years of expenses set aside. The difference wasn't wealth, it was structure. Cash also protects you from yourself during euphoria, not just panic. When markets are flying and everyone's getting rich, you'll be tempted to invest your cash reserve. Don't. That's when you need it most. Because when everyone's euphoric, crashes are near. And when crashes come, you'll want that cash to buy assets cheap, not to sell into strength. That's discipline. Keeping cash during booms is harder than keeping it during busts, because during booms you look stupid. Your friends are making money. You're sitting on treasury bills earning 3%. They mock you. They call you scared. But 6 months into a bear market, those same friends are panicking and you're calmly spending cash while your stocks recover. Who's scared then? Cash also gives you the ability to help family during emergencies without destroying your own finances. If your kid loses a job or your grandchild needs medical care, you can help without selling stocks at bad prices. That flexibility is priceless because life doesn't care about your portfolio balance. Emergencies happen regardless of market conditions. If all your money is in stocks, you're one crisis away from a permanent mistake. Now, let me address the inflation argument directly because it's the main objection people have. Yes, cash loses purchasing power, but your dividend stocks and index funds are the inflation-fighting parts of the portfolio. Cash is the crisis protection part. You don't buy an insurance policy expecting it to make you rich. You buy it to prevent disaster. Cash is an insurance policy against ruinous forced selling, and that insurance is worth more than the 2% you lose to inflation. In a proper retirement portfolio, you have different assets for different jobs. Dividend stocks are for income and inflation protection. Index funds are for long-term growth. And cash is for emotional stability and crisis liquidity. Use each tool for its intended purpose and why will survive. Use cash for growth and you'll run out of money. Use stocks for stability and you'll panic sell at the bottom. The structure is everything. I've outlined the 3 pillars of a survival portfolio. Dividend aristocrats, 40 to 50%, index funds, 30 to 40%, and cash equivalents, 20 to 30%. This isn't a formula for getting rich quickly, it's the only reliable plan for not dying poor.